Well, good morning, everyone. Today is Wednesday, August 28th. It's about 8:13 Eastern Time. Market's going to open up in about an hour and 17 minutes or so. Now, I'm expecting more sideways trading actions. And by the way, I want to thank each and every one of you for sending me that wonderful email yesterday, thanking me for doing these daily updates. I really, really appreciate it. If you guys are getting something out of it, please email me at support@marketgeeks.com. I'm really happy to get them. Thank you once again. Thank you very much. You guys all know who you are, who send me those nice emails at support@marketgeeks.com. Thank you once again. So now, let's talk about it. Tomorrow we have the GDP and jobless claims. Don't expect too much market action before that. I'm expecting markets to be choppy sideways, remaining within the twilight zone, meaning between the 50-day and the 200-day moving average. The GDP and the jobless claims are going to set the tone tomorrow. Now, it's almost better for the economy because of the behavior that we've seen from the Fed and our President Trump. It's almost better if these numbers are bearish, if they're weaker. And I'll tell you why. If they're weaker, the Fed has a good case for lowering rates next month. If the numbers are not weaker, the Fed does not have a good case for lowering rates next month. The bond market is right now pricing in 80% chance that the Fed is going to cut rate. So if the numbers are really, really positive, it's going to make market participants second guess whether the Fed is going to lower rates or not next month. And since the bond market is pricing it in at 80% right now, it's going to cause markets to go south. So it's almost better, believe it or not, it's almost better for the number to be a little bit weaker than positive. Then Jerome Powell can go and say, yeah, I told you so. The numbers are weak, economy's slowing down, we have to lower rates again. If the number is positive, he's in a corner. What is he going to do? We got to lower rates because maybe in the future economy's going to slow down. It's harder to do that, okay? So not expecting a lot of market action till we get the GDP and the jobless claim tomorrow and the personal income and consumer sentiment on Friday. But tomorrow is going to be the bigger part. We're going to know before the market opens tomorrow, about an hour before, because the report comes out an hour before. We're going to get a good idea of what the Fed is going to say next month. So, as far as sectors, right now, real estate, utilities, and consumer staples, all three are defensive sectors. Those are the sectors that are leading the top 10 sectors within the S&P 500. And the S&P 500 is not strong right now. It's right at the 200-day moving average, especially if you look at it internally. So you want to focus on real estate sectors, utilities, and consumer staples till the S&P 500 is trading above the 50-day moving average. Let me show you that right now. Let's look at the futures contract so we can see a little overnight data. We're right now, literally, that's the 50-day moving average. That's the 200-day moving average. As you see here, right in between. We're moving sideways right now. And I expect us to continue moving sideways at least till the GDP data's out. Until we're trading for 2 days above the 50-day moving average, I don't want you to look at speculative sectors like technology and consumer discretionary. I want you to keep focused on utilities, real estate, and consumer staples. All right, now, let me show you some stocks that are within this sector. So if you want to go and see stocks in this sector, you just type in utilities here, and then you go to constituents. And it'll give you a list of every stock, and then you can see how which ones are strong, which ones are weak. So for example, real estate, right? Let's say we want to see the strongest stocks in the strongest sectors, which is real estate right now. Boom, profile. Gives you all of them. There you go. I'm just kind of going backwards and forwards. There we go. Constituents. Sorry, not profile, constituents. I was pressing the wrong button there. All right, so that's how you get XLRE, XLU. Let's look at XLP. I believe Costco is an XLP, and that's a really good defensive stock. Walmart, Costco, yeah. Take a look at consumer staples right now. It's the defensive sector until the S&P 500 is between the 50 and the 200-day moving average. Consumer staples should be rallying. Let's look and see how it looks on a chart. Yeah, we're near all-time highs right now. Notice this is the consumer. This is the consumer staples, and now this is the S&P. Look at the difference in strength. Do you see that? Look at it again. If you're going to invest in a sector right now, would you rather invest in a stock that's within 1% or half of a percent of making new highs, or one that's trading below the 50-day moving average, as you can see right here? It's the same chart. It's just we're looking at it right now with the indicators. That's the 50-day. That's the 200-day. Now look at XLP, just to give you an idea of where it is. See how much higher it is? That's the 50-day line, and that's where it's trading. Is this the 50 or the 200-day line? Let's see. No, that's the 200-day line. Let me show you the 50-day line. Yeah. See, we're still trading above the 50-day line. Whereas if you look at SPY, you'll see how it's trading in between. So consumer stocks are trading right here near the highs, and SPY is trading here. So you definitely want to look at real estate, utilities, and staples till the stock market's trading above the 50-day line. And the 50-day line right now, if you're on the SPY, is at 294.10, and if you're trading the E-mini S&P, is at 29.40. I'll talk to you guys tomorrow. Take care. It's a big day tomorrow. We're going to have a big report because GDP comes out at 8:30 Eastern Time. Talk soon. Take care.